This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Welcome back, Invest Like a Billionaire podcast listeners. We've got a really fun show for you today. We're joined by Jeremy Goff, and Jeremy is formerly working at Blackstone, which was the largest alternative asset management company in the world at one point, and still probably is, and has been in the alternative space for over a decade, and has recently started his own shop in private credit. So we're going to talk a lot about what that is. I also dive into conversations around energy markets, which he has a background in, and where that's going. And
so juicy. Where is oil going? So with great deep background in the energy sector, as well as private credit, which is this amazing kind of mix between income and safety and upside opportunity. So you definitely want to hear about this.
Enjoy. Welcome back to the Invest Like a Billionaire podcast. I am your co-host, Ben Frazier, joined by fellow co-hosts.
Bob Frazier.
And today we have an in-person guest that we're really excited is here. Yes.
Jeremy Goff.
Jeremy
Good to be
Goff.
here with you guys.
Yes, thanks for coming. We
Absolutely.
don't get to do it in person very often, so this is really fun where you kind of have a little more personal interaction here. So it'd be great. And Jeremy and I actually used to work together at a company called Tortoise Capital Advisors. And Jeremy's here because he has started his own firm called Hiram Capital, doing private credit or lending to real estate, bigger real estate. And so we wanted to bring him on, just kind of what's going on in the market. Interest rates are increasing, just kind of understand a little bit what's happening in the private credit world. And you work with a lot of institutional investors. And again, our podcast is trying to educate about what are the big boys doing and how are they investing. So Jeremy, talk a little bit about your background.
Sure. So I've got a little bit of a non-traditional background, I think. Prior to my time with Ben over at Tortoise, so I started my career in the military. And then as I left, I was sort of trying to figure out whether or not I was going to do an MBA. At that time, it was, just after the financial crisis. So as you can imagine, the MBA programs were very full of other Wall Streeters trying to figure out what they're going to do, and decided not to. And so was lucky enough to meet some folks from Blackstone at the time. And I was a very non-traditional hire for them, but ended up sort of making it through that process and working for Blackstone for a number of years.
For those who don't know what Blackstone is, I mean, they're kind of 800-pound gorilla in the alternative space.
Yeah, they're a very large alternative asset manager focused.
Aren't they the largest?
I would say they're probably the largest, and they span the alternative spectrum. So everything from hedge fund of fund investing, private real estate, private credit, and I mean what they're known best for.
Yeah,
is
they
the
are
private equity
humongous.
space. They are
humongous. Yeah. All the largest institutional investors, go to them, and So yeah.
I think I think Sean Clem's
to $1 trillion in assets.
They are, in fact,
I think
they have an infrastructure fund that has close to $1 trillion in commitments.
That's with a T, not just a B.
Yeah. So
forget Invest Like a Billionaire.
Yeah. I mean, it's great. It's, and I'm sure they would tell you the same thing. It's always great to have that kind of capital at your disposal, I would say, but it also creates issues
honestly
for value investing. I mean,
where do you put that much money? That's the problem, is how do you create 10-15% returns when you're dealing with 10 figures?
I think it's finding these little avenues, and we were talking a little bit about this before we started the podcast. And I think on the energy side, for example, they owned a company called Cheniere, and for folks who don't know what Cheniere is, it's a publicly traded company today. It's an LNG export company. And so
back when that wasn't even cool.
It wasn't even known, right? It was like sort of like, I hope this works out at the time. And they're like the number one LNG exporter in the world.
And
right
what
now.
is LNG?
Exactly. Liquefied natural gas. So
So it's where they take the natural gas, which the problem with natural gas is it's all local, right? It has to be piped through pipes. And so you can't ship natural gas from here to Norway or wherever it's needed.
It has to be compressed.
It has to be compressed and liquefied and then put on special tankers, and then it can be shipped. But that's a fairly new technology.
It really is.
actually,
And I think at the
LNG
time,
tankers.
they were looking at that trend and saying like, hey, there's one, they were already looking at the shale plays and they knew that oil and gas production was going to get very strong in the United States. And they also knew that the United States would have to become an exporter of hydrocarbons. And so who do you start investing in to capture that value 10 years from now? Well, a company like Cheniere is a good one.
Yeah. So they figured that out, and you helped put together their equity strategies. Is that what you did for the
So
oil
I
and
worked
gas?
primarily on the private equity strategies. I would say probably the thing that I learned, I guess the most knowledge I gained was I worked for someone, his name's Tony James, and he was the president there for a long time, just recently retired in January. And I worked on a lot of his special projects and investor presentations. And I would say sitting with him and working on those presentations and how he looked at the world and how he took what seemed to me to be completely disparate data sets and built them into a story to convince institutional investors, who, by the way, are some of the most sophisticated investors in the world, that what Blackstone was doing was the right place to be.
Yeah.
It just really, I think that's what really got
And
me
they've
into
been
it.
right over and over and
They
over.
have been. And it's what really sort of, I was like, there's a way to figure this out. And again, it's not rocket science. It's just work. And it's exciting, right? It's kind of fun.
So before we go too much further, let's just take a break and talk about the public market. So
Sure.
we had a fun little conversation, while we're waiting here a minute ago. But as we sit here, the markets are, crashing and then rallying and crashing more. And so, what do you think about? What's your opinion of the public markets?
They scare me. I think they scare me to death. And we still monitor, even though we're not involved in the public markets, we still monitor Bloomberg. And there are days where I just don't even turn it on because I just don't want to see the flashing red, or if it's flashing green, it's like, how long is that going to last? But
I was telling you, in our studies, we're in the real estate business quite a bit, and looking at public REITs, real estate investment trusts, which are real estate packaged into a public stock, that all of a sudden trade, because they're public, they trade at an average of, let's say, 7 times the book value, meaning that $7 investment buys you $1 worth of real estate. Why is that? I mean,
liquidity premium.
It's nuts. Well, it's more than liquidity premium. It's hype factor, or fear factor. It's it's all priced based on nothing. It's priced, fundamentals no longer really matter, do they?
I don't think they do. And quite frankly, I don't know that a lot of REIT investors that are investing on the public side even know what's in their REIT, right? They're buying it, but do they really know what's sitting inside of there? You could possibly be overexposed to retail, right? And if you're overexposed to retail, well, COVID was a very bad time for you on your REIT, right? Or you could be in a hospitality REIT, right? And that was bad. So I think, you still have to look at what's in there, because it's not wrapped in a nice package and you can trade it via the equity markets. Doesn't necessarily mean that you shouldn't pay attention to what's sitting inside of it.
Yeah, and so if you pay $7 for $1 worth of real estate, and that real estate does super well, now it's not worth $1 anymore; it's worth $1.10 or $1.20.
Mm-hmm.
Does the stock go up or down? I mean, you have no idea, because it's not based on that. It's based on a random, kind of emotion attached to this, right? And the celebrity factor, and or marketing factor, and or information disinformation factors.
Well, we were laughing about the names, right? We were laughing about the names of these securities, but the fact of the matter is that sometimes it works. And closed-end funds are a great example next to REITs. If you look at some of the closed-end funds today, like folks buy these at the IPO, right? And they sit there and they immediately go to a discount, right? So their NAV is trading at one place and the price of the security is trading at another.
So explain that real quick.
So a closed-end fund is essentially, it's a portfolio like a mutual fund, but it's in a closed-end wrapper. So it trades like a stock. You can buy it via a ticker.
So they don't issue more shares or
they can
withdraw shares.
A point, but I would say that like most of them trade at a significant discount.
So they can either trade at a premium to what they own, or a discount to what they own. So they
very rarely do they trade on NAV, right?
Net asset value, which is par, what it's actually worth. The underlying assets.
That's right. It's very rare that you would see one actually trade that way, and it's very rare that you see one actually move to a premium. I would say in most cases they do
trade at a discount. Yeah,
they do.
So just, this whole, this podcast is focused on really opening up the door of alternatives to everyday investors and to high net worth investors. So you're in that camp. I mean, you love alternatives, right? I mean, alternatives. There is so much you can do with alternatives in terms of income, in terms of capital preservation, in terms of growth. What are your favorite strategies today, and how are you playing your own placing your own capital? Are you in the public markets?
I'm actually not, and I would say that and I do put a lot of my own capital into my own products. So that's important for our investors, and also that we have skin in the game, which I think if you're looking at alternatives, you should always find a manager who does have skin in the game.
Yeah, for sure.
It's a meaningful way to show support. But, it's funny. I think that alternatives are misunderstood. I've heard you guys talk about Swenson before when he built the Yale portfolio. And he was really the godfather of alternatives for institutional investors and how to understand them, which is why the Yale endowment has done so amazingly well from a return perspective. I think, I grew up in this industry sort of looking at private equity, and I think trying to understand why it's valuable as opposed to a public stock. And I think it's very different, right? So in private equity, and please stop me if I'm moving too fast, but in private equity, it's essentially a pool of capital that has been committed to a manager, and they are out looking for companies that are either private to begin with or are public today, but they would like to take private in order to create more value within that company. And that value is created by cleaning up the balance sheet, and whether that's adding leverage or taking away leverage, depending on the market, that could help. I think in a lot of cases, and private equity gets beat up for the way jobs work within those companies, but I would say that their biggest goal is to create efficiencies within the company. So I think over the long run, if you were to look at private equity portfolios, you do see job creation within those portfolios through efficiency, but they're bringing in operational experts from other companies in the industry and really just trying to build a better company. And so one example I'll give you, and this is kind of a funny example. So Blackstone bought Hilton at the top of the market. The hotel business at the top of the market. And I think at the time, and that transaction was done, I believe, by a gentleman by the name of Michael Che, but I could be wrong. But anyway, so they bought the company. It was at the top of the market. And everyone's like, oh my gosh, there's no way that this thing's going to turn out okay, right? And so, but ultimately what they did was they made Hilton more efficient, allowed them to grow it internationally, and ultimately exited a hugely valuable company that was operating way better.
Did they take it private? Or
they did take it private.
Yes, they took it private to get rid of the scrutiny, basically let them operate, put it on the operating table without criticism and scrutiny and public regulation, et cetera. They put it on the operating table and, turned it into the $6 million man, and then turned it public again, right?
That's right. And that is the strategy. That's ultimately, that was a great way of putting it into a nutshell. It's literally take a private company or take something private, make it better and take it public again, or sell it to a strategic buyer who will continue to add more value to a business.
Of course, nobody probably knows what the $6 million man was.
I've heard about it.
It's like something from the 70s, right?
I think it was the 70s or 80s. It was the bionic man. It's like,
well, with inflation today, he'd be like the $6 billion.
There you go. There you go. So talk about, so you were at Blackstone doing the private equity transition into the kind of energy space, and you took some of these. Yeah,
well, energy became really interesting to me because that's what I was working on, right?
Yeah.
And so Blackstone decided to separate their energy business from their core fund, which has always been Blackstone Capital Partners, which is a multi-sector fund that can focus on anything. And when shale and U.S. production became very strong, and there was even a lot of production going on off the west coast of Africa, they decided to take that team and create. Now, this didn't mean that the core fund couldn't participate, but they did want to have a concentrated strategy within energy. And so that really interested me. And I was born and raised in Kansas City. I never planned on staying in New York long term, and my boss knew that. And so I got to know the folks at Tortoise as I was looking to come back to Kansas City, and just coming off of the energy fund at Blackstone, it was a good fit. I had no experience in public markets.
So and Tortoise, for anybody who doesn't know, became one of the largest kind of ETF businesses in energy. So they were the first
at one
to
point
package
they were
up
the
MLPs,
largest MLP holder probably in the world.
Yeah. And so an ETF is an exchange traded fund. So it's basically you take these pools and you it's like a mutual fund. You go public and it trades. So like the S&P.
Yeah, in many cases it's passive, so it's based on an index that
So interesting. I mean, we want to talk about private credit strategies, which hopefully we'll get there, but the energy space is super interesting right now too. So now you are primarily the equity strategist. You're the guy with the Lego set trying to figure out how to construct, the ultimate investment vehicle. But, energy is interesting. I mean, you see oil is hovering around $100 a barrel.
It's insane.
And all of a sudden people may not realize the U.S. has become the world's largest producer of oil and gas.
I think JP Morgan had a 185 number out there at one point.
So nuts. So yeah. I personally have been predicting for years deflation in the oil space because of technology. What happens? I mean, we saw in the 90s the fracking revolution that basically eliminated a massive amount of risk in drilling and unlocked, billions and trillions in hydrocarbon production for previously uneconomic kind of deposits. What happens when that goes to the Guar field in Saudi Arabia? What happens when that technology is deployed in Russia? And so there's no shortage of hydrocarbons and in the planet. And so my view was that technology was going to suppress prices. So
I think we saw that happening, right?
Yeah.
Well, I think we saw that happening, right? I think at the peak of the shale boom, when U.S. producers arguably were sort of at their peak production, not peak production, but were producing more than they ever had before. We saw oil prices come down. I think, at one point, I believe we were down close to $28 a barrel or something like that. And I think everybody was shocked. Like, what are we going to do now? Right. And it's great for some. It's terrible for others.
Yeah. These guys, this technology allows them to ramp up production incredibly rapidly. And so, but then they got smacked down, then punished by Wall Street. Well, and so now everybody's like, prices are high, and they're saying we're not going to increase production because we don't want to get smacked down.
OPEC's losing control, right? They're like darn the U.S. Like OPEC no longer has pricing power, and they're meeting for days on end, right? And it was interesting. I mean, I thought that the days of $100 oil were completely gone.
Yeah,
but then there's always an event that proves us all wrong. Always. Always.
So where are you bullish on oil, or
I think what it does show is that I think what it shows is that we were all, so the market got very excited around renewables and clean energy too, right? And I think the price of oil coming down and producers laying off production and everybody buying Teslas, everybody got really excited about green energy. COVID happened, and then everybody was like, oh yeah, like nobody's going to drive cars anymore. We're all just going to, and what we realized is like that we were a little quick to the punch on that. And I think that what we realize is that we still need oil and gas, right? Because
Europe's figuring that out.
I mean, and I think all the people driving Teslas still don't realize that it takes all those hydrocarbons to fuel those gas-powered power plants.
Where does the electricity come from?
So,
hello.
So now that oil goes back above $100 a barrel and the gas prices are going up, everybody's like, well, I don't understand, but we're all still very dependent on it, and we're going to be. This idea that we can wean ourselves off of oil over the next 20 years is I think it's a little short-sighted, but that's just my opinion. So
we are seeing it. We are seeing renewables, continuing to take a greater and greater market share, which I'm super happy about. But and we are seeing, we saw actually in the Western world, we saw consumption at least flattening during the recession. I think it's picking up now, but conservation is working, and these.
Well, and interestingly, I think nuclear power was ultimately, there were obviously some horrific accidents that occurred there, but I think Europe was a little quick to sort of say like shut down all the nuclear power plants. I mean, honestly, I think that was probably also a little short-sighted.
I know it's
easy for me to say sitting
now
here
it's
now.
The new clean energy.
Right?
I
mean, it's easy for me to say now because we're sitting here going like, oh, you should have kept those open. But it's a tough decision to make.
So where's the best play in the energy space right now?
Oh, that's a great question. I mean, I think honestly, I believe that there are still and I'm speaking to within the United States. If I'm someone who has capital to put to work in the United States, and I put some to work myself in this area, there are still producers within the United States who have interesting acreage that are producing steadily oil and gas every day. And these guys aren't traded on the public markets. They do raise funds to support what they're doing. We can always introduce folks to those people, but I think it's on the private side.
Private companies.
They are,
I totally agree.
And the way to do it today is just privately. You cannot find value in energy in the public markets, in my opinion. I think you have to find private players.
You can't find value in energy in the public markets, which I agree. So it's so funny because I just did my first private oil and gas investment. And,
great to hear.
And unfortunately, I don't know anything about oil and gas, So it's it's part of me doing my due diligence on operators, right? And go figuring out if so place a little bit of capital and go, let's see how it works. But the numbers are insane with these guys, especially with $100 oil.
Well, and there is ways
the returns are incredible.
There's ways to invest with guys that really it almost looks like a fixed income play, because really once these guys are up and running, they're just paying you cash flow off of the sale of their oil. And it's honestly it's a pretty steady play, right?
A lot of these smaller operators have much lower overhead and operating costs, so their break-even price of oil is much lower than
and there are structurally ways to do it so that you don't have to worry about that overhead.
Well, and there's people don't realize how fragmented the market is. You think about the Exxons of the world, but there's thousands and thousands of small operators who have 32 wells in western Kansas, on 1,000 acres, and they're just cranking out the cash.
Yeah.
And they're looking.
And even more so now. And I think, I think the toughest part I had with everything that occurred as we started to go back to $100 oil was, the idea that, that these big oil behemoths, the Exxons, the Chevrons of the world, could ultimately just turn these spigot back on overnight and reduce gas prices, and that everything would go back to normal. In the structural ability for them to do that is just impossible, right? Because this is still a very large operation that's taking place. And so even to see the value catch back up is going to take a while.
Yeah. The funny thing to me is the political infrastructure too. And we don't want to be a political show, but you look at, the White House is calling for, greater production out of Venezuela, for crying out loud. But, we're the largest oil producer in the world. Do we not want to increase production? So it's kind of nuts, right?
It is.
It is kind of hypocritical, BS.
But which is why I can understand that someone looking at the markets and saying, I still believe in energy, but how do I capitalize on this? The messaging is very confusing. Right?
Yeah.
And so
it is. So the small energy player is such a good opportunity, but boy, who was it that said, the definition of an oil well is a hole in the ground with a liar on top. So you got
never heard that. That's good though.
You gotta find the great operators is absolutely critical, and that's true of all the private space. That's the hardest thing about private investments, right? And alternative investments is finding the right operators.
Well, in our business, in private credit, obviously, and especially on the real estate side where we do some work with development and construction, I think it's all about who the developer is, right? I mean, ultimately for us, it's about their track record, their ability to execute, their ability to get it done.
So you started in private equity, worked in kind of public equities on the energy side, and now you've transitioned back to the private debt side.
Yeah.
So
we like that.
We like that.
Yeah.
We know that space. So talk a little bit about, what drew you to that. What are the attractive dynamics, especially in this environment? How does it kind of, compare contrast with public equity or private equity, I should say.
And maybe first define private debt. I mean, everybody thinks about debt and people think debt is bad, right? But debt is great.
The way
we're not talking about banks here, right?
No.
Okay,
we're not. And I like to think of it too. It's just to sort of bring it back to kind of what you guys have spoken about before. It's a lot like saying I invest in a hedge fund. A lot of different hedge funds out there. There's a lot of different private credit, right? And the way I got into it was ultimately while we were working at Tortoise, we started really looking at alternatives just to diversify the asset base that Tortoise had. And private credit, got really interesting to me because I saw that there were a way to find opportunities where you're acting as a bank essentially, but you're able to structure things in a way that take you away from public market exposure, right? Meaning that like I'm not pricing something on a spread to, we don't use LIBOR anymore, at least we say we don't. Whatever the benchmark rate is you want to use for today, I guess. But we're really looking at, okay, we're really pricing credit, and I think most private credit investors do this. We're pricing credit based on risk and not based on what the public markets are telling us it should be, right? So we go in and we look at our counterparty, we look at their experience, we look at, really the dynamics within that submarket or whatever that market is, and try to determine what the best way to do that. And generally speaking, we're using probably the equity cost of capital as more of a benchmark than we are a benchmark rate, if that makes sense.
Okay, so bank. Everybody knows what a bank is, right? You go stick your money in it. You do it for free. Basically, they don't pay you anything. And they go make loans sometimes, but mostly not.
Right.
And they hold the money. And so that's really boring. So how is what you're doing different than that, right?
And I think it goes to a bigger trend.
So you're a bank. I mean,
I don't want to say that because I'm sure there's a lot of regulations.
You're an unregulated lender.
Right.
So is there a gap in banking? Is there?
Yeah. And I think it really, the financial crisis changed obviously a lot of things. But also the bank's ability to take on too much exposure was one of the things that really was really the genesis for private credit markets really coming to life, I think. And what and you're seeing it take place. It's a larger trend just than what we're doing. So if you look today and you were to go look at a leverage buyout transaction, which is ultimately how private equity firms buy their companies, they use a good deal of debt alongside their equity to get that done.
So you go buy a public company, you go borrow money to do that.
So you're basically cleansing the balance sheet and recreating a new balance sheet. And traditionally before the financial crisis, it was always the large bulge bracket banks that were the large financiers of that debt.
Gotcha.
The Citis, the JP Morgans, the Goldman Sachs. Well, what they realized was that, if the banks can do that, why can't I lend on an LBO too? So now if you go and you look at the cap table of an LBO or leverage buyout, and let's say you look at KKR's cap table, you might see Blackstone credit in the debt side of that capital stack, because now these guys are like, we can just do the debt between each other. And so you have this huge direct lending movement taking place within the private equity markets, creating BDCs, which is a business development company focused on small businesses. And so it's interesting, I don't think the banks are getting pushed out, but it's definitely released some of the pressure on the lending side. And I think now you also have guys who, and it's not that banks don't have all this experience within the transactional space. I do think you have guys who have transactional experience that are able to also price it effectively.
So maybe break down just maybe a sample deal of when you guys come in, where you're at in the capital stack, and just kind of all the players.
Sure. So the way we generally look at it, and I'll just use a development deal as an example. So we work with a number of different developers and construction companies, and who do they develop assets all across the country. And really what we're looking for is guys that are doing deals in areas that we feel like have appropriate density, meaning like the population makes sense.
You like the project.
We like the project. And so we start talking about what their typical cap table will look like. And one of the ways that we've really, sold ourselves to them is that, okay, today a bank may lend 60% loan to cost, meaning the cost of the project, they will loan them 60% of that. If the
cost is $1 million, they'll loan you $600,000.
Correct. And the rest is equity. So 40% equity in a deal is a lot for an equity holder, right? For a developer. Right. So he's doing 2 projects, but like his ability to do multiple projects becomes very slim.
Right. He's doing 1 deal instead of 2 deals.
Right. And oh, by the way, if he's using a regional bank, there's only so much they can lend out to a guy at one time.
Right.
And so you need other people in that ecosystem to be able to do financing. And so
they'll come to you.
They'll come to us.
But the rates may be significantly higher.
They are, right? Because ultimately, like we're looking at, if the bank, the bank's loan to cost ultimately is our sort of metric on risk, right? We're like, if the bank's looking at this, now a lot of that's based on just what they're able to do. But they're not looking at really the developer's track record, and they're not looking at the demographics of the. Maybe they are, but like. I think we're probably looking at it more granularly than they are.
Right.
And so, but we also like the bank being there, and we don't want to do anything that's going to disturb or disrupt sort of their piece of the pie. And so we'll work with the developer to make sure that we can come in and do sort of a junior slice is what I like.
So you'll do a second lien, basically. So yeah, it is higher cost, but it's also a smaller slab. And so the cost is not that high, the net cost.
And the way we're modeling this, right, the way we're having it make sense is that ultimately, if you're able to reduce their equity exposure, their return on investment is actually our position is actually accretive to their return, right?
Yeah, that's right.
Even at double the bank rate.
So instead of $1 million build, you got to come up with $400,000 in equity. Maybe it's $200,000.
Correct.
So all of a sudden I can go do 2 deals.
That's right.
And so the opportunity cost is there. So
and if they have to go raise 40% equity, that cost of equity from a private investor.
So you're filling a niche that the banks won't do, and possibly offering investors maybe high single digit returns, right, which you can't get anywhere else, right? Certainly not in your bank.
That's right.
And pretty safe, right? Because you guys again are more sophisticated. We do find, that you can be sophisticated underwriters and underwrite to things that banks do not do, but they make a lot of sense to underwrite properly. Our debt fund is now 10 years in the running, soared through COVID, and we have very, very, very smart, very clever underwriting, but it's very different than how a bank would underwrite.
Agreed.
And it's more mathematical based and that kind of thing. And literally it's been proven out through good times and bad.
Yeah, listen, I don't think nobody, like, it's like the guy standing on the hole, say making promises. I think there's always something that's going to come up that you don't see, right? And every portfolio, like, is not going to be perfect. But what you're trying to do is create a portfolio that has enough diversity between developers, geographies, and all of that to reduce your loss risk.
So from an investor's perspective, if they put money into a deal like this, a private deal, if the market goes up or down or whatever, it doesn't affect them.
It doesn't matter.
That's pretty cool, and potentially income, which is the hardest to get piece, right, in your portfolio is how do you get current income, right? So that's no problem in a debt piece. And then what's possible. I don't know if you guys do it, but it's possible in the private debt space. You also get an equity kicker.
You can.
You get warrants. That's right. Explain what a warrant is, or an equity kicker.
I look at it like an option, right? It's like an in the money option that you can exercise to add a little juice to the return at the end of the day. And I think it's something.
So you get a piece of the deal. Not only do they owe you money, but you also get a little slice of the upside.
That's right.
In addition, so you get to play.
That's right.
You get to play,
That's
but
right.
You have no risk, pretty much, or very little risk of downside loss. You get current income, and you get to play a little bit.
That's right.
Man, I love that.
Yeah, it's fun. It's fun.
I love those deals, right?
Yeah.
Because the first rule of making money is what? Don't lose money.
It's funny too, because I think when we talk to a lot of prospective investors, the one thing that always comes up is liquidity, which I'm sure you guys discuss quite a bit. And it's this idea that going into a private fund is a lockup, right? And everybody's like, well, my money's going to be locked up for 6 years, and what if I need liquidity within that time?
Right.
And my explanation to them is like, one, I think people have an irrational need for liquidity that they don't actually need.
Right. It's more of an emotional need than an actual need.
I think it is. And I guess my thing is like, well, if you gave me $1 million and I pay you 8.5% every year on that $1 million over a 6-year period, is that enough liquidity in your mind? Ultimately those deals are going to roll out as well. So it's not like your money's locked up for the full time, right? As a deal matures and is harvested, you're getting your principal back. And so I think one thing for investors who haven't done a lot of private fund investing is understanding that that is not truly like a lockup of your capital forever. There are distributions and everything that take place within the life cycle of a fund. But I also think that low volatility, you get to see like where your principal is all the time. It's staying there.
Right.
The ability to reduce volatility and correlation to markets is really valuable for anybody.
Right.
I think.
So in liquidity, so let's say you've got a $5 million portfolio. What is your real liquidity need? Let's say worst case scenario, I need $500,000. Well, then take $500,000 and make sure it's liquid, and roll the other 4.5 into something that is. You don't need that liquidity, because liquidity is expensive.
It is really expensive,
super expensive,
especially with inflation.
Well, the opportunity cost alone of cash, right?
There you go.
And
then add the public markets. Yeah, the public markets are liquid, but at what cost? When you watch overnight values crash, over a 6-month period by, 85%.
I mean, we can look at
in some
Netflix,
cases.
right, as a great
Perfect
example.
There, you have liquidity, guys. Of course,
and
it's a whole lot
arguably one
less
of the
than it
best,
was.
and arguably one of the best hedge fund managers in the world took a bath on that, right? So it's like it's like no matter how much work you do, how much you pay attention to fundamentals, like we were talking about, like you can take a huge loss based on somebody's emotion, right?
Exactly.
So it's interesting, and I think ultimately, I think Netflix just came back down to a valuation that's more attractive and actually makes more sense. But
aren't they still negative cash flow? I mean, I can't remember. I mean, how much is a company worth when it's just a bonfire of cash? So how do you value a company that is literally throw your cash in the thing and light a match? So it's hard for me to say.
It's hard, but I think that's the problem, right? Is that's a hard decision for anyone to make, right? And I think even the best guys in the world have a hard time determining at what point that's going to happen, because ultimately you don't.
Yeah, every quarter, let's throw $1.2 billion.
I mean, everybody sold off on one news, and then within the same earnings report, they said that they were literally going to do 10 times worse on the next quarter, and everybody's like, oh wow, so like, what does that mean?
I know. I honestly, just the private markets are so much more predictable, and you can really solve the unknowns and make good decisions that are not based on emotion and not based on celebrity factor or something. It's control over outcomes.
It is control over outcomes. And that's how we always explain it, is that we don't have control over everything, right? I mean, the environment that we live in is unpredictable, but at the same time, we have the time and patience to make sure that our outcome is better than what it might have been if we were a forced seller in a market. And that's the difference, I think.
So what are you kind of seeing right now in this kind of current environment where maybe there's some turbulence, obviously in the public markets, interest rates are, going up, and that.
I mean, 75 basis point hike is coming, whether we like it or not. So yeah.
So how are you? I mean, at this point, economic cycle, where you're at is actually probably a pretty good place to be, because you've got equity usually covering your position. You're second behind a lender.
Yeah.
But what are the kind of things you're looking at? You're in a lot of industrial. It's kind of the primary asset class.
Yeah, we really love industrial right now. And I think everybody, it's
hard not to.
It's hard not to love it. And I think ultimately, between everything that's taken place across the world from a conflict standpoint, has made everyone realize that we need to bring a lot of the logistical supply chain back onshore. And listen, this is a cycle. Like if you look back, I mean, this cycle takes place. We've done this 2 or 3 times, right? Where we offshore, then we onshore, and I think, I'm like this huge student of Howard Marks, because he looks at everything within cycles, right? And in every market, you have a main cycle and all these multiple cycles. And I think for us, industrial right now as a large cycle is in a very good place. And I think that you're going to continue to see build out onshore of logistical supply chains. And I think not just because of last mile overnight Amazon type shipping, but generally speaking, we're going to need more warehouses everywhere.
Right.
And we like that. And I think for us, the hardest part is in capturing this opportunity is finding the smaller markets where this cycle is early, right? Where we're in the early innings of that cycle, because not every Kansas City, in my mind, is probably a little later inning than like a Boise, right? And so we're trying to find where those later inning assets are, or early inning assets are, and that's tricky, right? Because like, where are they going to build and where's it going to go? But and I think that's all about finding the right partners from a development standpoint for us.
So yeah, industrial space, but what about the debt space? I mean, you're watching the bond market, right?
Well, we're
jumping off.
I don't want to say we're laughing our way to the bank on that, but I think it's for us. It's the ability to create. Now, listen, we have to adjust our own pricing based on that, right? And ultimately, what may end up happening is we price a little lower than we should have based on how quickly interest rates move up. That doesn't bother me, right? Because I'm not losing money on that deal necessarily. And I think the ability to create income without volatility is also really important. I mean, the ability to know that like you're going to get that coupon payment every quarter. I mean, that's what it's about.
And so you're not like a bond, like buying a bond, because you when the rates are a lot higher, so there's a lot more margin, right? A lot more spread, and because so it's just a very different animal.
Yeah, and I mean, like I said, I think I look at what we do as more of a spread to equity than I do a spread to LIBOR or SOFR or anything like that, because we're looking at what the cost of capital on the equity is and what they can survive with and still be accretive to the whole project.
So from an investor's perspective, it's like a high yield bond, but without volatility.
Yeah,
and
that's right. Because our duration is also short,
risk.
right? So like if you look, I mean, we may.
So much your loans are a year or two, or
well,
3?
I would say like we may write a 5-year note. Interesting, like so the other, you're kind of. I'm trying not to change topics, but the interesting thing about private credit is our ability to be really, really flexible and creative in structure,
right?
Which banks are not great at, and I think we all know that. And so what we're able to do is like take something and say like, okay, well, we're going to do a 5-year note. I think the duration on that is probably around 36 months max, right? And then we will give ourselves call protection for 18 months, meaning like whether or not you sell this thing, you're still paying us 18 months worth of interest on it, right? So that's how we create stability and consistency within the debt instrument.
Right. So good.
Very cool.
All right.
Well, thanks so much for coming out.
No, it's been great. Great conversation with you guys. I really enjoyed it.
What's the best way if people want to learn more about Hiram?
Sure. So we have a website, www.hiramcap.com. You can reach out to us on there or find us on LinkedIn or any of the other social media outlets that I personally don't have a lot of experience with, but I'm sure someone that we work with does. So.
Awesome. Well, thanks so much, Jeremy. It's been an awesome conversation.
Thank you, guys.